We're jumping straight into MRA today. Everyone is watching the price action, but the real story is their massive AI infrastructure pivot.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Subscribe and hit the like button because honestly, looking at the data we have today, it's one of the most fascinating corporate transitions happening right now.
It really is.
If you've been watching the markets or the tech sector over the last couple of years, you've definitely seen MRA flashing across your screen. But we aren't here to just read off daily price action or get caught up in social media hype.
Right. There's way too much noise out there.
Exactly. So our mission today is to figure out what is actually going on under the hood of this company. We've got a stack of early 2026 financial data, some analyst notes, and market sentiment reports. And the big question for you today is MRA just a volatile crypto mining play that lives and dies on Bitcoin, or is there a foundational artificial intelligence story brewing here?
And that tension is exactly what we need to unravel. Because to evaluate an entity like MRA, you really have to take a step back. You have to look completely past the daily ticker volatility and that whole retail trading frenzy.
Yeah, block out the noise.
Exactly. You have to meticulously examine their actual physical energy infrastructure and the stark realities of their balance sheet. Because when you comb through these early 2026 documents, the narrative the market is trading on is, well, it might be vastly different from the operational reality on the ground.
Speaking of operational reality, I was looking at the top line numbers, and frankly, I'm a bit confused by the contradiction here.
The revenue numbers.
Yeah, the revenue. So they pulled in $656 million in revenue for their latest reported period, which sounds incredible. And to add to that, the data shows a positive earnings per share of $2.89 over the trailing 12 months as of September 30, 2025.
Right.
And just for anyone newer to reading these sheets, trailing 12 months just means looking at the previous 12 consecutive months of performance. But when you look past that impressive $656 million, the profit margins tell a completely different story. Help me make sense of this disconnect.
It's a textbook revenue versus profit paradox. And it's exactly why we have to dig into the mechanics behind those top-line numbers. That positive EPS and the robust revenue mask a very challenging reality.
Because they're losing money on the actual operation.
Heavily. Despite generating that $656 million, MRA reported a gross profit hole of negative $159.37 million.
Wait, how do you bring in over $600 million and still end up roughly $160 million in the red on gross profit?
Because it costs an absolute fortune to run these mining operations at scale. Their operating expenses ballooned to negative $465.48 million. You have to remember, generating that revenue is not just writing software. It requires immense amounts of physical power, constant hardware maintenance, heavy facility overhead. The top line is booming because they are successfully mining and selling digital assets. But the sheer brute force cost of keeping tens of thousands of machines running in cooled ANs, it's eating the gross margins entirely.
And a substantial part of that margin squeeze brings us right to the April 2024 Bitcoin halving, doesn't it?
Absolutely. That was a major catalyst.
Because I see in the notes that their mining output for the full year of 2025 was 8,799 Bitcoin. That's a lot of digital currency, but it actually represents a 7% drop year over year. For those who don't live and breathe crypto, can you give us a quick refresher on why that drop happened despite them running all those machines?
Sure. The halving is a fundamental feature of Bitcoin's code. Roughly every 4 years, the reward that miners receive for processing transactions and securing the network is literally cut in half.
Just slashed overnight.
Exactly. So in April 2024, the amount of Bitcoin MRA received for the exact same amount of computing work dropped by 50%. Couple that with something called network difficulty. As more computers join the Bitcoin network globally to mine, the algorithm automatically adjusts to make it harder to win that block reward.
So they have to work harder for less.
Precisely. The machines consume much more of that incredibly expensive energy for a perpetually shrinking slice of the pie.
They're essentially running on a treadmill that is constantly speeding up and getting steeper.
That's a great way to put it.
And that explains the next data point, which is frankly a jaw-dropper. They released their full year 2025 results on February 26, 2026, and the report showed a $1.7 billion net loss for the year.
A massive hit.
By all traditional financial metrics, a $1.7 billion loss should trigger a brutal sell-off. Yet the stock actually saw a post-earnings rally. The market looked right past a $1.7 billion hole and decided to buy anyway. Why on earth would investors reward that kind of cash burn?
That's the fascinating contradiction of this company. The market is clearly looking forward. They're pricing in expected operational efficiencies, but more importantly, they are pricing in the raw value of the assets MARA already holds.
Right.
They aren't treating this like a normal software company where a bad quarter means the product is failing. They're treating it almost like a resource extraction company sitting on a very valuable stockpile.
And this is where it gets really interesting, because the reason the market can shrug off a $1.7 billion operational loss is entirely due to MRA's balance sheet. According to the early 2026 data, MARA holds 53,822 Bitcoin.
That's a staggering amount.
It is. They aren't just mining and immediately selling to keep the lights on. They are holding an absolute treasure chest.
Let's do the math on that to really put it into perspective for you. At the time this data was compiled, Bitcoin was hovering around $87,498 per coin. If you multiply that by their 53,822 Bitcoin, that treasury is valued at approximately $4.7 billion.
$4.7 billion.
Yeah. $4.7 billion in highly liquid assets sitting directly on the balance sheet. It provides a phenomenal amount of stability and financial flexibility, completely irrespective of whatever operational losses they take on the mining side.
And they aren't just letting that $4.7 billion sit there gathering digital dust in a cold wallet. This was one of the most surprising facts I found. MARA actually generated $32 million in interest income simply by lending out 9,377 of those Bitcoins.
Right. They've turned a fraction of their treasury into a passive income-generating machine.
To put that in perspective, their passive side hustle makes more money than many mid-sized tech companies make in a year of full operations.
Exactly.
But wait, I have to push back here. That $4.7 billion valuation is entirely dependent on Bitcoin staying high, right? Isn't it incredibly risky to base your whole corporate transition and balance sheet stability on an asset that is notoriously volatile? A macro shock could slash that treasury value by 30% in a weekend.
You're entirely correct about the volatility risk, but we have to look at what that treasury allows them to do right now. Let's look at their operating cash flow. In one recent period, that negative operating cash flow hit negative $677 million.
Ouch.
Normally, if a traditional company burns through $677 million in cash, they only have two choices to survive. They either go to the bank and take on toxic levels of debt with crushing interest rates.
Or they issue millions of new shares.
Right, which significantly dilutes the value for everyone currently holding the stock.
But MRA doesn't have to do either of those things.
Precisely. Because they have a $4.7 billion strategic cushion, they can easily offset those negative cash flows. They can use calculated strategic sales from that Bitcoin treasury to fund their operations.
And our data also shows recent net financing inflows of $3.95 billion. So between the financing and the crypto treasury, they are essentially insulated from relying heavily on traditional debt markets to fund their expansion.
Exactly. They have a massive safety net.
Okay, so they have this $4.7 billion cushion. But having a mountain of cash or Bitcoin doesn't automatically protect you from competitors like Riot or CleanSpark deciding to just buy faster machines and edge you out of the market. What is MRA's actual defense against the rest of the industry?
Their primary defense isn't just about having the latest microchips. In an industry where energy is the single largest bottleneck, their defense is the power grid itself.
The actual grid.
Yes. MRA's built an ultimate moat around their business, which is 1.9 gigawatts of secured power capacity. Competitors can raise capital and buy all the hardware they want, but if they don't have the secured physical power capacity and grid interconnection rights to plug those machines in, they simply cannot compete.
You can't just plug these into a wall outlet.
No, securing that kind of power takes years of regulatory approval, infrastructure build-out, and negotiation. It creates incredibly high switching costs and formidable barriers to entry.
Let me try to contextualize 1.9 gigawatts for you, because it is an abstract number that's hard to wrap your head around. 1.9 gigawatts is roughly equivalent to the power consumption of a small to medium-sized city.
It's massive.
Imagine capturing all the electricity needed to run every home, business, traffic light, and hospital in a sprawling metropolitan area and dedicating it entirely to your company's computing needs. That is the sheer scale of the energy moat we are talking about.
What's fascinating here is how MRA is beginning to utilize that city-sized energy footprint. They realize the treadmill of Bitcoin mining is getting tougher, so they're executing a profound strategic pivot.
The AI pivot.
Yes. Instead of solely using that 1.9 gigawatts to run cryptographic algorithms for Bitcoin, they're transforming their operations to provide grid balancing compute capabilities and diversifying directly into the artificial intelligence and data center space.
Let's define grid balancing real quick. That essentially means they can act as a shock absorber for the local power grid, right? Like, if the wind stops blowing or the sun goes down and the grid needs more power for homes, MRA can power down their mining machines in seconds to free up electricity.
That's exactly it. And often they get paid by the utility companies for providing that flexibility.
So they're turning a rigid expense electricity into a highly valuable, flexible utility function.
Yes, and they're using the capital generated by their crypto operations to buy their way into the physical layer of the AI revolution.
The specifics of this transition are incredibly telling. We're looking at a 64% stake in a company called Exaeon, as well as a major strategic partnership with Starwood Capital. These aren't just crypto side projects.
No, these are deliberate moves into high-performance computing and real estate infrastructure.
Furthermore, there's a lot of unconfirmed speculation swirling around in these early 2026 analyst notes that approximately 15,315 of their Bitcoin has been specifically allocated to asset management to fund mergers and acquisitions of hyperscalers in the AI space.
And a hyperscaler, just to clarify, is a vast cloud data center provider. Think of the immense warehouse-sized facilities that provide the computing backbone for major tech companies and AI models.
Exactly. If MRA is using their Bitcoin treasury to buy up AI data centers, that fundamentally changes the identity of the company. It means they're using the wealth generated from the early Wild West days of crypto to purchase the physical infrastructure of tomorrow's technology landscape.
So what does this all mean for the investor or the observer trying to make sense of this? We have to carefully examine the risks and look at the bear case, because jumping into a transition of this magnitude is certainly not for the faint of heart.
I'm glad you brought that up, because we want to impartially report on how the broader market is viewing this. When you look at the analyst community notes, there's a distinct undercurrent of caution. The overall market sentiment right now is distinctly neutral.
Very cautious.
We're seeing specific analyst actions reflecting this wariness. For example, Clear Street recently downgraded their price target for MRA quite drastically, taking it from $16 down to $9.
Yeah.
They are clearly looking at those post-halving production declines and demanding to see proof before getting bullish.
The bear case presented by analysts like those at Clear Street is essentially arguing that the execution risk of pivoting from a pure crypto miner to a diversified AI data center is exceptionally high. It's not as simple as unplugging a Bitcoin machine and plugging in an AI server.
Right.
Bitcoin mining uses specialized machines called ASICs, which are relatively rugged and, as we discussed, can be turned off in an instant for grid balancing.
But AI data centers require high-end GPUs, like the ones made by NVIDIA, which need intense, often liquid-based cooling systems, and they require 99.99% uptime. You can't just power down an AI training model because electricity prices spiked for an hour.
Precisely the issue. The infrastructure requirements, the cooling demands, and the customer acquisition strategies are completely different businesses. Analysts are holding neutral because they want to see if MAR can smoothly navigate this complex transition without burning through their $4.7 billion safety net.
That makes total sense.
And of course, the primary macro risk remains the volatility of Bitcoin itself. Our data shows that just recently, amid rising geopolitical tensions in the Middle East, Bitcoin dropped down to $68,000 on March 6, 2026. When Bitcoin drops, MAR's treasury value drops, and their mining margins get squeezed even further.
That makes total sense on paper, but this analyst caution is constantly battling against the sheer momentum of the crypto market. The momentum flow in this sector is wild. We see time and time again that crypto stocks surge heavily. The second Bitcoin reclaims that psychological $70,000 to $72,000 range.
It's very event-driven.
Yeah, MNRA is a highly volatile ride that is still largely driven by external macro catalysts. A geopolitical event can send it tumbling, but a broad crypto rebound can send it skyrocketing. It's a momentum trader's dream, but it requires an iron stomach.
This raises an important question. If you were watching this company or researching this sector, what exactly should you be looking out for next? Let's map out the immediate catalyst calendar for the next 3 months based on the data. The most significant event on the horizon will be their Q1 2026 earnings report, which is expected to drop in late April or early May of 2026.
So for you listening, here are the specific triggers you need to be watching closely over the next 90 days. First, the macro level, will Bitcoin stabilize and hold confidently above that $70,000 mark? That provides the baseline margin safety for their ongoing mining operations.
Right, that's step one.
Second, keep an eye on the broader economic picture. Will impending interest rate cuts by the central banks trigger a sector rotation? When borrowing gets cheaper and risk appetite increases, we often see investors rotate out of safe, defensive stocks and back into high growth, high risk assets like crypto miners.
And third, and perhaps most importantly for the long-term thesis we've been unpacking, will that heavily anticipated AI infrastructure revenue actually start to ramp up in the post-FY 2025
His
earnings?
ultimate test.
Exactly. We know they took a $1.7 billion net loss in 2025 while building this out and fighting the halving. The market will be laser-focused on the Q1 2026 earnings call to see if those investments, like the 64% stake in Xion and the partnership with Starwood Capital, are beginning to yield tangible, top-line AI revenue. That is a critical pivot point from speculation to reality.
Okay, let's pull all of this together. We've covered a tremendous amount of ground today, pulling from complex financial disclosures, analyst notes, and market momentum data. To summarize the core takeaways, MIRI is a deeply complex entity caught in a massive transitional phase. On one hand, they are actively battling severe halving headwinds, rising network difficulty, and operating expenses that drove a $1.7 billion net loss last year.
A very steep hill to climb.
But on the other hand, they are armed to the teeth. They possess a 1.9 gigawatt energy mode, literally enough secured power to run a city, and a $4.7 billion liquid crypto treasury that allows them to shrug off negative cash flows without diluting their shareholders into oblivion. They are uniquely positioned to attempt a profound transition from being a pure-play Bitcoin miner to a highly diversified AI-driven infrastructure powerhouse.
It truly is a remarkable corporate evolution to witness. The broader takeaway here is how they're attempting to leverage the extreme wealth generated by the early days of cryptocurrency to buy their way into the physical foundational layer of the artificial intelligence boom.
Which leaves us with a final provocative thought for you to ponder as we wrap up today's analysis. If companies like MRI can successfully pivot their vast secured energy resources from simply hashing algorithms for Bitcoin into physically powering the hyperdense data centers that drive artificial intelligence, are we actually witnessing the birth of a completely new kind of modern utility company?
That's the real question.
If computing power and electricity are the ultimate foundational currencies of the AI revolution, will the future valuation of companies like MARA be tied less to the daily price fluctuations of Bitcoin and much more to their sheer physical control over the global power grid? It's a fascinating concept to keep in mind the next time you see their ticker moving across your screen. Thank you so much for joining us on today's breakdown. We highly encourage you to keep questioning the numbers, looking at the bigger picture, and joining us next time as we unpack the market's most complex stories.